morning, everyone, and thank you for joining today's webinar on gearing. I'm Kirsty Lamont, and I'm here today with our investment strategist, Hugh Lamb. Welcome, Hugh.
Thanks, Kirsty.
So as well as being part of our investment strategy and research team here at Betashares, Hugh is also a CFA, a Chartered Financial Analyst, and he is our resident expert on all things gearing. So Hugh, I hope you're ready because there's been a lot of interest, around gearing lately, how it can be used by investors, how geared ETFs work, and how they can be incorporated into investment portfolios. Are you ready?
Extremely excited. Yeah,
Good to hear. We've had a lot of great questions sent through already, and today we'll try and get through as many of those questions as possible. And we'll also be doing a quick fire session where we run through questions around the Betashares range of geared ETFs. And then at the end, we'll have about 15 to 20 minutes where we'll be taking your live questions. So please do send those through for Hugh today as well. All right, now, before we begin, let's do the obligatories. Some important information for everyone. Obviously, what we're presenting here today is general information only. We don't know your individual personal circumstances, so when we're answering these questions, really general answers, and please do seek financial advice. Now, some housekeeping notes. At any time during the webinar, you can ask questions using the Q&A box that you should be able to see on your screen, and we'll be able to see those questions come through at our end so that we can answer them towards the end of this session. And then after the webinar, we'll be sending out a recording so that you can view it on demand. All right, a quick little note about Betashares for those of you who may be new to our brand. So Betashares is a leading Australian wealth manager. We serve over 1 million investors around Australia now and their financial advisors. We have the broadest range of exchange traded funds on the ASX. We have over 90 funds now covering a range of different geographies, asset classes and themes. And we recently hit $40 billion in funds under management. Okay, so let's get into it. Hugh, do you want to start us off and maybe give us a bit of a rundown? How does gearing actually work?
Yeah, sure. So I might start off with firstly what gearing is. In a nutshell, gearing is borrowing at its heart. Think about a company. They might take out a loan from a lender or a financial institution in order to use those funds to either buy capital, invest in the business in order for that business to continue growing. There are other sources of funding, such as through equity, through shareholders, but that avenue might not be feasible for all companies. So debt is a common way. So at its core, gearing is, borrowing. But how gearing works, the next question is, how much can I borrow? There's definitely limits to how much a company can borrow or an individual can borrow. So what a lender or a financial institution will do is that they will assess the credit riskiness of this borrower. And they'll do so looking at the loan to value ratio or the LVR ratio. So some of you might be aware of what this ratio is. It essentially takes the amount that you borrow, which is called the loan amount, and then it will divide it by the value ratio. That is just the total amount of capital, which is the initial invested capital along with the borrowed funds together. So when you divide the borrowed amount by the total value, that's where you get the LVR ratio. So if a bank or a lender, views you to be, have a good credit history, you've had a history of paying interest payments on this loan consistently, then they'll be more likely to lend you more money. And so that LVR increases to 50, 60, 70%. So in this example here, we've got a slide that kind of explains what's happening behind the scenes. So if we take an example of an LVR ratio of 40%, let's say we have $100 of initial capital to play with, to invest in the stock market. What this calculates to be at a 40% LVR is we can borrow $67 roughly for our $100 invested capital. How we get that 40%? You get the $67 divided by the total capital, which is 100 plus 67. That's $167. So now you've got not just $100, you have $167 that's invested in the market. So you can see how the power of gearing now works. You know, you can have more of your capital being exposed to the market than compared to an ungeared strategy. So if we look to the slide, to the right-hand side of this slide, in a couple of scenarios, let's say the share market rose by 10%. We know that we have around $167 in capital. If the share market rose by 10%, then that's a value increase of around $16.67. Again, that brings up our capital even further to around $183. The percentage return on that investment seeks out to be 16.7%. That is greater than what the share market rose by, which was 10%. But similarly, that in a way that gearing can magnify our potential gains, it can actually reverse in losses if the share market did correct steeply. So in scenario 2, if the share market declined by 10%, that invested capital base, that $167, that sort of orange chart on the right-hand side, that would fall down by 10%. That magnifies the loss to that minus 16.7%. And so the key takeaway here is that gearing is very powerful, but it does come with potential losses if the share market goes the other way.
Yeah.
On the flip side, you can generate quite substantial positive returns. So that's how gearing works.
Thanks, Hugh. That is an excellent answer and much more detail than I think I would have got if I'd gone to ChatGPT. So well done there. Can you talk us through, I mean, it's a great overview, but why are the reasons that an investor would want to use gearing?
Yeah, sure. There's probably a few different ways that an investor might want to use gearing. It really depends on what your personal situation is. But one example is for that outperformance potential, as we talked about here. You're increasing your invested capital base beyond what you can contribute. And so think about a young accumulator who might not have sufficient funds to really build wealth over time. Gearing can provide that benefit to a young accumulator.
Yeah.
Think about things like inflation and taxes as well. These two concepts can erode investor capital. And so it is quite difficult to maintain a real after-tax return because inflation might be high in some periods. Think about the period from 2020 onwards when inflation rose rapidly following the pandemic. Taxes are fixed and they're quite high in Australia compared to other developed countries in the world. So you have these two forces that are eroding into your capital base, and gearing provides you that power in order for you to have an opportunity to maintain or growth wealth over time. So that's really the key benefit, but I guess that benefit really differs for different investor bases out there.
Yeah, absolutely. And tell us, one of the questions that's come through to us is how do fund managers like Betashares gain access to gearing? And maybe if you could give an example.
Yeah, sure. So investors can gain access to gearing. Well, fund managers can gain access to gearing in a similar way that a corporation or an individual can. We have an arrangement with our own lender or banking institution for the loan that we invest in the underlying securities or ETFs that our ETFs hold. And so the key benefit of this is that because of our scale and our expertise, the rates on our loans that we borrow are typically lower than what an individual can get through a margin loan. As of now, the rates that we get are more than 3% cheaper than published rates or variable rates on margin loans across the big four banks. So that's a considerable advantage. Again, because you're getting exposure to this lower institutional rate, it lowers your barrier to achieve positive returns. In order for you to achieve positive returns through a geared strategy, your investment needs to achieve more than what the interest is being charged. So, for example, if you took out a margin loan at one of the big four banks at 9 to 10%, your investment would have to generate more than that amount in order to just break even. And that's quite a high barrier to achieve.
Yeah, it sure is. No, that's some really interesting background. And tell us, what are some of the methods that investors can use to access gearing?
Sure. Yeah. So there's a few ways. I touch upon margin loans. Margin loans are a common way to gain access, but there are a few disadvantages with this. Firstly, the rates are quite high. Anywhere from 9 to 10% variable across the majors. But secondly, you have the risk of being margin called. So what happens is, if the value of your investments drops significantly, then you'll enter a situation where you're margin called. Effectively, you need to have ample liquid assets in order to meet that requirement from the lender, and so that increases your liquidity risk. Another few ways that you can gain access to gearing is using the equity in your home. That's another way, and also installment warrants as well.
Yeah.
But finally, internally geared ETFs such as our Wealth Builder range also provides that opportunity, and I'm sure we'll talk about it a bit more in this webinar.
Yeah, well, that's a great segue to our next question, talking about geared ETFs. Can you talk us through how gearing works internally?
Yeah, so internally, I guess we know gearing at its heart involves borrowing. So what happens is we borrow from our lender, our financial institution, and that loan is invested into the underlying securities that the ETF holds. So it magnifies our exposure to the market. When you combine the capital that the investor has contributed, our investor base, alongside the borrowed loans, that together creates, magnifies that exposure. It's known as the gross asset value because we're combining two different sources of capital together. So I guess that's what happens, behind the scenes. From a tax perspective, I guess we can delve into this a bit more. But on the income side, we receive interest payments, we receive dividends and capital gains as well. But on the expenses side, we can expense deductibles, tax credits, etc. But yeah, I'm sure we'll delve into that a bit more.
Yeah, for sure. That's a great rundown. So I guess, we've sort of covered off, the basics of gearing, how gearing works within ETFs. A lot of questions that we've had come through are around the benefits and the risks of using gearing in your portfolio. So maybe let's start off. Do you want to talk us through some of the benefits?
Yeah, sure. So I kind of touched upon this earlier. The benefits really differ across different investor bases. I need to sort of disclaim first, but first one is that that outperformance potential. Say you've got limited investor capital, you can sort of magnify your exposure to the market to generate, the opportunity for wealth creation over the long run. But another key benefit is that because you're increasing your exposure to the market, you can also increase the opportunity to enhance your income. So say you have an ungeared investment in an ungeared ETF, you might still receive dividends on that. But by using a geared strategy, you can actually enhance the dividends received on it. So say instead of $100 that you receive in income through dividends, that might magnify even further to say $110, $120 as well. So it really differs for what type of personal circumstance you have, what your risk tolerance is. But yeah, in a nutshell, you've got firstly that outperformance potential and also opportunity to enhance after-tax income generation as well.
Yeah, okay, nice. And what are the costs involved in gearing, and how might they impact overall returns?
Yeah, so with the costs, we need to make a distinction as to what type of gearing exposure are we getting. If we think about a typical margin loan, that cost is the variable 9 to 10% that you're paying across the big four banks. So again, that is quite a huge barrier to overcome to generate, positive real returns. But from an internally geared ETF perspective, such as the funds that we offer, the fees really come in a management fee. As with any ETF, you'll pay a management fee. That varies across different ETFs. For our Wealth Builder series, that is 35 basis points on the gross asset value of the fund. So that is really the ultimate cost that you're paying. It is substantially lower than some other active managers out there. So that's the real benefit you're getting. It's a very affordable way to access a powerful investment strategy.
Yeah, thanks, Hugh. And let's move on to talk about some of the risks involved in gearing. Can you give us a quick summary of what some of those risks might be?
Sure. So with any investment, like it carries risks. I touched upon how gearing can be powerful in up markets because your investment can grow more than the market. Your potential gains are magnified.
Yeah.
The risk is, in the opposite scenario, your potential losses are magnified as well. If there is a market event or a crash, a left tail risk event, such as COVID during 2020, we actually saw, geared strategies typically underperform the market significantly. So that is definitely a risk that investors need to be wary of.
Yeah.
And the key takeaway with this is that if you're investing in any sort of gearing strategy, you need to ensure that your time horizon is long enough to weather any probability of losses that may occur. You don't want to, there are different use cases. Some people might use gearing as a core within their portfolios or as a tactical strategy. But yeah, investors need to be wary that sometimes the market can turn negatively and in a sharp way.
Yeah. And are there particular investing environments where a geared ETF might underperform the most?
I think that if we broaden the question, any investment that you make, that will depend on the entry cost that you enter into. So, if you entered at the top of the market, then your cost base is much higher. So the barrier to achieve high returns might lower. However, if you just bought into a environment where the market has sold off, you've significantly lowered your cost base. And so the probability of you achieving positive returns is higher. So the same concept applies to a geared strategy, except that it magnifies it. Say you invested at a cycle high and we faced a steep market sell-off, then those that return would magnify to the downside. However, if you've invested at the bottom of a cycle and you had a lot of support in the market from a central bank, then again, that lifts your value up significantly. So, we are not providing any financial advice as to when to enter in and out of the market or what market environment is most suitable. Again, it really depends on your entry point, but we advocate to take a long-term view when investing in any gearing strategy and to hold a nice diversified basket of securities as well.
Yeah, absolutely. Very important when it comes to a lot of investing and particularly gearing. What are your thoughts on the current market environment? We have had a lot of people asking us, how does the current market environment impact the effectiveness of gearing strategies?
Yeah, there's a lot of volatility in the market recently. We saw the Japanese yen rally significantly over the last few weeks. There's an upcoming election happening. There's geopolitical concerns. So, these are all risks that are front and mind, for investors. But, generally, we are of the view, our investment community as well, that, the market environment is generally supportive. Growth is still positive across developed economies. We've seen inflation coming down in a nice disinflationary trend from their highs in 2022. So the backdrop is generally supportive. Yes, there might be some pockets of weakness in certain economies. The US retail consumer, there are signs of weakness in terms of credit card delinquencies and whatnot. But generally, the environment is supportive. And so what that means is that from an asset allocation perspective, equities, should generally do well. Again, this is not financial advice, but yes, this is our view from a Betashares investment community perspective.
Yeah, no, definitely insightful. Let's change tack and talk a bit about portfolio construction and gearing. What are some of the ways or use cases that an investor can incorporate or use gearing in their portfolio?
Yeah, it's a great question because there's just such a breadth of funds out there, and it's like if when you choose what you want to use, such as a geared strategy, how do I actually implement that within a portfolio? I mentioned it a bit earlier. I mean, one way is to use it as a core within your portfolio, as a wealth accumulation tool. So a good example was a young accumulator with limited savings. However, they have the discipline to invest on a consistent basis, whether that's every month, quarter, etc. And so that could be used to generate consistent long-term returns or wealth over time. However, there are other strategies out there that use a higher level of gearing or higher LVR. Typically we advocate those strategies to be used a bit more tactically, just because the return profiles can be a little bit more volatile. And so you don't want to necessarily place that within the core of a portfolio. That might sit outside it. And depending on what your personal circumstances are, that might be a return enhancer generally, alongside a more stable core portfolio. So those are probably two ways you can use them within their portfolios. There are some investor bases out there that might use gearing to enhance the after-tax income that it generates. Some investors have a strategy and focus on income more so than capital gains, and gearing can actually enhance your income potential. So those are a few different use cases.
Yeah, thanks for that. Now, one of the specific questions that we've had come through is, can leveraged ETFs be used as a way to outperform in the long term through dollar cost averaging, or is it more of a short-term active strategy?
Yeah, so I kind of answered that in the previous comment. So to your first question, yes, you can definitely use a gearing strategy to build long-term wealth through a DCA strategy. The idea is that you're not timing the market. You're consistently adding capital that generally over the long term should provide positive returns. But yes, there are opportunities as well to use gearing a bit more tactically. Again, you can have a more stable core alongside a more return enhancing ETF structure. So
yeah. Now, we've had a lot of interest as well in particularly gearing for SMSFs. Can you clarify for us, Hugh, whether SMSFs are able to use gearing strategies, and are there any restrictions?
Yeah, it's a really good question, and it's a common question that we've started to receive a bit more. So to answer the question, gearing is not prohibited for SMSF, so you can access gearing strategies. However, there are very strict borrowing conditions. So it's what the ATO calls a limited recourse borrowing arrangement. What that means is that you can only actually use a gearing strategy for one asset. For more details, please visit the ATO website. But there are a lot of complexities behind that, because if you are approved for a limited recourse borrowing arrangement or an LRBA, then you do need to set up what is called a bear trust, because the asset needs to be held separately in that trust. And those trusts can cost anywhere from $1,000 to $3,000 to set up. So again, by increasing your cost through this arrangement, you're increasing the barrier to achieve positive returns. But internally geared ETFs, such as the ones that we provide, they're not subject to the LRBA. And so it's it's a much simple strategy and easy to access solution for SMSF investors to access a gearing strategy.
Right, I didn't know that. Good to know. And okay, so now that we know that it is available to SMSFs, what would be some of the benefits of using gearing, particularly for SMSFs?
Yeah, it's a good question, because SMSFs, there's a slight nuance to other investors. The major difference is taxes. We know that SMSFs and generally the super vehicle environment as a structure invites a lower tax base. So the tax rates within super is 15%, which is much lower than other marginal tax rates. And so when you combine something like a geared strategy that has the potential to magnify potential gains combined with a very low tax environment, you can only imagine how much capital that can grow over time. And super also invites a very long-term time horizon. Again, there are different investor bases across the super cycle from accumulation to pension phase. So the use cases might differ. In accumulation phase, generally investors might want to seek a bit more capital growth in their working years. But in pension phase, perhaps income is more of a focus. And so, gearing still offers that opportunity and that solution to increase after-tax income. So there are a number of different use cases within super that I think gearing can provide for. So
great. Thank you for that. All right. Well, I think some very insightful answers there. Thanks for running us through that. I think at this point in time, we might start moving into our quickfire Q&A to answer the questions that have come in recent weeks about the Betashares range of geared ETFs. So we'll do that. I hope you're ready.
Yeah,
I know you've answered a lot of questions so far, but it's time to really bring your game up for the quickfire session. And after that, we'll then move on to answering some of the live questions that have come through from the audience to date. So keep sending those through, everyone. I can see a lot have come through already, and we'll definitely have time for those towards the end. Okay, so quickfire. Firstly, can you talk us through the various Betashares geared ETF options and particularly our new Wealth Builder range?
Yeah, sure. So we have a few geared options. The Wealth Builder options were really developed recently as a ETF structure with a lower or moderate level of gearing. And so we have G200, which is a moderately geared Australian equities ETF with a leverage range of around 30 to 40%. And we also have GHHF as well. So that is a diversified all growth geared ETF. It has the same
so that's a geared version of our popular DHHF.
Yeah, it's a very popular question because it's not exactly a geared version. I think there are a lot of questions as to whether GHHF is a geared version of DHHF. It was inspired by the composition of DHHF, but the constituents itself isn't exactly the same.
Okay.
But just coming back to our suite, so we have G200 and GHHF as our Wealth Builder series. So that employs a 30 to 40% LVR, as opposed to GEAR and GGUS, which have a LVR that is slightly higher at 50 to 65%. So we do have a broad range of geared ETFs at different levels of gearing as well. So you may or may not be comfortable with the higher levels of gearing that GEAR, which is our geared Australian equity fund, and GGUS, which is our geared US equity fund. Those leverage ranges are much higher than the Wealth Builder funds. So a Wealth Builder fund like G200 and GHHF, that might be more suitable to be used as a core within a portfolio because yes, the leverage ranges within that are just slightly lower. And so some investors might be a bit more comfortable employing that within their portfolios.
Right.
In terms of the fees as well, the fees are 35 basis points for G200 and GHHF. That's on the gross asset value. And then for GEAR and GGUS, it's 80 basis points as well.
Okay. And when we're thinking about, long-term buy and hold investing, how appropriate are some of the newer moderately geared funds, the Wealth Builder funds for that versus, the bigger geared funds like GEAR?
So they're quite appropriate, just given that the leverage ranges are lower than that of a higher geared strategy. And so coming back to the point, investors are a bit more comfortable with having that lower leverage range. There's probably less volatility in returns over the long run, so it might be a bit more suitable as a long-term buy and hold core solution. But again, with any sort of strategy, you should be taking generally a longer term horizon with geared investing. With a higher geared strategy like GEAR or GGUS, that might be used a bit more tactically on the sidelines.
Yeah, absolutely. And in terms of other questions that have come through about the Betashares product range, how do the funds achieve a high gearing ratio with such a low fee, especially when interest rates are so high?
Yeah, it's a good question. I touched upon it briefly earlier in this webinar. We have a borrowing arrangement with our lender and financial institution, and because a fund manager like Betashares has breadth, scale, and expertise, we're able to negotiate a very competitive institutional rate, which is significantly lower than what you would expect if you were to take out a margin loan or a separate loan by yourself. And so, yes, interest rates, I think they were generally high. They still are high, but they're actually coming down across developed economies. So, in terms of, so you are able to, access, generous amounts of leverage at institutional costs through a wealth builder ETF or a geared ETF, particularly ones provided by Betashares.
Yeah. Now, another question we've had, how does rebalancing work, particularly around that gearing range target?
Sure. So the gearing ranges for the wealth builder ETFs, so G200 and GHHF, that's between 30% and 40%, the LVR, which I touched upon earlier. And so what happens is the fund seeks to maintain, a gearing range within that, lower and upper bound. If the fund does go outside of that or below that, then what we do is we actually rebalance back to the midpoint. So the midpoint of that range is 35%. Naturally, if the market sells off, that actually increases the gearing multiple. So we actually have to rebalance back down to the midpoint. Similarly, if the market sold off, then the gearing multiple would increase. We would have to rebalance back down. And so this is on a daily basis that we seek a certain gearing multiple. And so there's a few questions as well that, well, how come my total returns over a certain period, say 5 years, it doesn't match what the gearing multiple shows on the website? That's because we target the gearing multiple on a daily basis. So that might not necessarily add up to what you see on a total return basis because of effects like rebalancing and then compounding that over time.
Yeah, absolutely. Now, last question in this quickfire session that's come through. Can you buy or sell geared ETFs directly from the Betashares investing platform? Great question. Thank you for whoever sent that one through. And also from other public trading platforms.
Yeah, so with any ETF like our wealth builder funds, yes, you can definitely invest in it using our investing platform, which is Betashares Direct, and we'll go into that a bit later. But you can also access it through any other investing platform as well. It's just important to know what the ticker is, so I'll reiterate it. So it is G200. So G200 is our moderately geared Australian equities fund. And then we also have GHHF, which was inspired by DHHF. Again, it is a moderately geared, diversified all growth ETF as well. So you can punch those tickers into the Betashares Direct platform or any other investing platform. And it's a very simple, low-cost solution to, access the powerful investment strategy of gearing.
Yeah, and so geared ETFs essentially can be bought and sold just as any other ETF.
Exactly right.
Yeah, good to know.
Yeah.
Now let's change tack. We've had a lot of questions come through around gearing and tax considerations. It's a bit of a complicated topic, but it's great that you're a chartered financial analyst, so this should be easy for you to answer. What are the tax implications of gearing for investors?
Sure. So with the tax implications, with gearing, it's a borrowed strategy. We take out a loan to invest in the market. For an individual, if you're taking out a margin loan to invest in any income producing asset, whether that's a stock or bond, the interest expenses on that loan is tax deductible on your personal tax return. However, if that loan instead was used for a private purpose, you will need to apportion the different use cases of that loan to the ATO. In a similar way that we as a fund manager can deduct the interest expenses on our own financial statements, individuals can do the same on their own personal loans. However, they can't necessarily do that with a geared ETF, which I think we'll talk to a bit later.
Yeah, okay. And what about tax breaks? Are there any tax breaks available to investors who choose to use geared ETFs in a portfolio?
Yeah, so tax breaks, I would assume that's probably more so what are the tax advantages or efficiencies of an internally geared ETF. In a nutshell, the interest expenses that are deductible on our side, that lowers the income or the taxable income that we receive as well. So what the end investor gets is a lower after-tax income component. And so, that can generally work in your favor because, a fund manager like Betashares, we're not incentivized to sell down assets to pay that after-tax income. That leaves more assets within the ETF to generate more and more returns over time. Saying a lower after-tax income might sound like a bad thing, but it's important to note that with a geared strategy, you do have the potential to increase that income component because your exposure to the market increases. So you might be, subject to your eligibility, have higher franking credits that could, in combination, offset that lower after-tax income that the end investor receives. So it's a bit of a complex area, and it's relatively hard to sort of explain the tax efficiencies, but there's no particularly tax break that an investor receives, but the vehicle that they invest in is very tax efficient. That they're investing.
Yeah, great answer. Now, another very particular question we've had come through on the tax side of things. Is the cost of gearing deductible from total income in a tax return in a similar manner to research costs and brokerage?
Yeah, so the answer is no. The reason why is because the interest expenses that are paid is made by Betashares as a fund manager rather than the individual themselves. So you can't actually claim that as a separate deduction on your personal tax return. You do get the benefit of, all the arrangements of the, gearing strategies and the payments on the loan met by the fund manager. So that's taken care of internally. You avoid, having to submit different sort of forms to the ATO as well. So there's a bit more simplicity investing in a internally geared ETF where all the arrangements are met within the one structure.
Okay. And thinking about the the Betashares gear and wealth builder funds, what we've talked about interest rates. How are interest expenses paid in the ETF, and how does this impact things like dividends and franking credits?
Yeah, it's a great question. So again, with the interest expense deductible in our financial statements, we can claim that as a deductible. If the expenses side of the ETF is greater than the income side, then investors won't be eligible for franking dividend, or franking dividends won't be paid out. However, that's generally not the case. Generally, the income received within this ETF structure is greater than the expense side. So, generally, franking credits do get paid. In terms of the dividend side, I mentioned that because interest expenses are deductible, it offsets the income received, lowering the after-tax income that an end investor would get. So, again, that lowers the dividend that you might receive, but it's important to note that that might be offset by additional income you might have received from franking credits. So it might seem like a bad thing that investors are getting a lower after-tax income, but it's important to remember that, gearing as a strategy, it enhances your exposure to the market, increases your income potential through, franking credits, and that might offset, the lower dividends you may receive.
Yeah. Makes sense. Thanks for that. All right, I think we are at the point where we are ready to move on to some live audience Q&As. So let's amp up the pressure on Hugh a little bit more. Let's see. We've got a question here from Chris. Why does GEAR's underlying holdings hold direct shares versus GGUS and GHHF, which hold ETFs?
Yeah, it's a good question. It comes to the product design. GEAR has been one of our legacy funds out there. There are numerous amounts of considerations, whether that's tax, currency hedging as well. It's a similar concept to why GHHF isn't exactly the same as DHHF. There are a number of considerations such as currency hedging, which allowed us to determine that having the exact same constituents as DHHF wasn't appropriate. And so, yeah, there's a number of different reasons why. But for example, with G200, the underlying constituent for that is our ETF A200, which I'm sure many are familiar with. So yeah, there are definitely a number of different considerations, such as tax, currency hedging as well, that explains the differences between why we hold individual stocks as opposed to an ETF. Yeah.
Okay. Now David would like to know, does it make sense to have both DHHF and GHHF in the portfolio? Is that a good practice to grow wealth? I mean, I imagine there's a few people that already have A200 or DHHF, and does it make sense for them to also have a geared, somewhat similar version?
Yeah, so again, this is not financial advice, and I can't actually provide, say which one is better or not. I think generally you need to think about what your risk tolerance is, what your time horizon is as well. Generally, the longer time horizon you have, your risk tolerance would increase. And so that might lend itself more so to a strategy like GHHF, which employs a moderate level of gearing as opposed to DHHF. The concept of GHHF, as I said, it's very similar to DHHF in terms of the diversified all growth approach that you're getting. I think the main difference is, quite clear. It's that leverage range of 30 to 40%. If you're comfortable with accepting that level of gearing, if you have a long enough time horizon, if your risk tolerance accepts that, then that might be suitable. But again, I can't provide any sort of firm suggestion as to which one is better or not.
Yeah, makes sense. Now Liam would like to know, does the 35 basis point fee on the Wealth Builder ETFs include interest on borrowed funds, or is that an additional cost to account for?
It's a really good question. The interest expenses that we paid, the interest is actually accrued daily. And so it's factored into the net asset value that you receive or hold as an investor in the ETF. It's not a separate fee that you pay. And this is another advantage of an internally geared ETF. Instead of paying a much higher rate on a margin loan, separately, all these arrangements are met by Betashares in our arrangement with our lender as well. And so it's just a much more simple, low-cost solution for a geared strategy. But yes, to answer the question, no, it's not a separate expense. There is a flat management fee of 35 basis points.
Good to know. Now, Matthew, question from Matthew. How does the fund meet its loan liabilities? How are loan repayments generated to return capital to the institutions that have loaned the borrowed funds?
So
that's two questions, really.
Yeah. I mean, with any sort of borrowed arrangement or loan arrangement, we do have significant amount of FUM within the strategy in order to make these payments. Obviously, typically we might pay that by, selling down assets or using other assets within the structure. But again, we do obviously have and run, different numbers of scenarios to ensure that we're able to make these interest expenses. Again, these are rates that are significantly lower than published rates on margin loans across, say an ANZ or Commonwealth Bank.
Mm-hmm.
But yes, it's similar to a corporation or an individual. We are subject to making those payments on a frequent basis, and also, our credit riskiness or our perception to be able to meet those payments would have been assessed at the time of the borrowing arrangement as well.
Yeah, okay. Now, Tom has asked a question, is Betashares going to develop a higher geared offer, say 80 to 90% geared?
Yeah, so not that I know of. I can't provide a definitive answer on that. I think our current geared suite is, it seems quite round at the moment. There was a lot of interest in having a lower geared strategy, which is why we developed the Wealth Builder series in G200 and GHHF. I don't imagine there would be a higher geared strategy above and beyond the 50 to 65%, but that's something we might want to confirm. But as of what I know, my current knowledge, that's not the case for now.
Okay, and next question, how is LVR maintained inside a geared ETF on a daily basis, apart from movement in underlying asset price?
Yeah, so it's a good question. We have triggers and rules that are monitored by our portfolio management team on the equity side. For example, the LVR range for G200 and GHHF, that sits at 30 to 40%. If the market rose significantly, then our LVR would have decreased. If it decreases beyond that 30% mark, as I said, we need to rebalance back to the midpoint, which is 35%. And in the opposite scenario, if we fall outside of 40%, we need to rebalance back down. On a daily basis, it's not that the rebalancing range has to sit at 35% exactly. It just has to sit between that band. So there's a bit of leeway between 30 to 40%. It really takes a sort of a market shock or a large movement in the share market in order for that rebalancing range to be breached. We've done a couple back tests on G200 and GHHF back to 2010. And, based on this analysis and research, we found that GHHF had around 13 rebalances during that 14-year period. So you can see that the rebalances were quite low. And most of those rebalances occurred during COVID when the market sold off significantly. Yeah. So our portfolio management team, theoretically in that scenario would have had to rebalance either back up or back down to the midpoint. Similarly for G200, the number of rebalances were around 11 from that back tested period in 2010. So you can see that, generally we don't rebalance frequently. This is, again, back tested data, it's not live, but it really takes a large shock to the market that would cause a rebalance breach and for our portfolio management team to rebalance back to the midpoint.
Yeah, that makes a lot of sense. Now, Andrew has two questions about gear. Firstly, why are the franking credits so high? And then secondly, the underlying loan, is it still a margin call facility?
Yeah, so to the first question, the franking credits are high because the LVR is higher. That is, the gearing range is higher. Because that is higher, the effective exposure increases. So with gear, the LVR range is 50% to 65%, as opposed to 30 to 40% for our Wealth Builder series. So that 50 to 65% LVR, that equates to a gearing multiple of 2 to 2.86 times. So theoretically, if you had $100 invested in gear, theoretically on any given day, you would expect $200 to $286 of exposure to the market, as opposed to a lower range for our Wealth Builder series. When you have a great exposure to the market, then you can receive more dividends, more franking credits, and that's why it's significantly higher, the franking credits. In terms of the margin facility, I would have to double check that. Just to confirm that question.
No problem. I'm sure we can get back to that particular investor with an answer on email for that one. Now, Stephen has just popped in a question about rebalancing, which we were just talking about. Good morning to you, Stephen. Stephen would like to know, doesn't rebalancing strategy mean that you are selling in a down market and buying in an up market?
It's generally true. So I did explain that. Let's take COVID, for example, when the market sold off significantly. So the understanding is, generally correct. When the market sells off, say during COVID, your LVR range actually increases. And the reason why is because your value of the assets itself, because that decreases, it decreases the denominator of the LVR ratio, that increases it back up rather than decrease it. So because it increases it, it might breach the upper end of the rebalancing range. Say it's 40% for the Wealth Builder series. We would actually have to rebalance back down to the midpoint. And so, yes, because of rebalancing back down, your exposure to the market has theoretically decreased by a bit. So the understanding is correct. But, generally over time, as I've said, we haven't generally seen too many rebalances across our suite. Our backtest has shown, there's generally, minimal amounts of rebalances except for like stress periods like COVID. And so, yes, I mean, to answer the question, yeah, we do rebalance back down if we do breach that barrier beyond the upper bound. Again, that's really subject to a steep sell-off.
Yeah. Okay. And talking about, those sort of rare events like a deep market crash, Steve would like to know, would a geared fund be itself subject to a margin call in that instance?
Would gear itself be subject to a margin call? Yeah, I mean, I think the question with that is, would we have to sell down assets to meet our liability or loan on that scenario? Gear is a relatively large strategy. There's around $440 million plus dollars within that. So, there would be theoretically, ample assets within that to meet it. So, yeah, I mean, the question to that is, it would meet, those a margin call theoretically, yeah.
Okay, now we are getting very close to the end of this session and we are pretty much almost through our live questions, but I have got one here from Andrew. The beauty of a managed fund is dollar cost averaging via direct debit. How do I do that with an ASX instrument?
Yeah, with a ASX instrument, it's traded on exchange. The beauty of that is, you can actually set up an account, whether that's through Betashares Direct. You can actually have your account linked to Betashares Direct, and so instead of direct debiting all the time, it's actually much easier to buy and sell. So say on the platform, you could enter in a buy order. Your details of your account is recorded, and so it's much easier and faster to process a buy or sell transaction, which I think is a bit more of a friendlier way to invest rather than through a managed fund. But yeah, it's quite simple. You can download the Betashares Direct app on the Apple Store and also Google Play. So it is open and available for investors.
Yeah, good to know. All right, I think we are almost at time, so we'll need to wrap it up there. Thank you, Hugh, for answering all of those questions on the spot.
Thanks, Kirsten.
Now, just to wrap things up, we wanted to talk just very, very quickly about something we've been working on here at Betashares, which is our new investing platform, Betashares Direct, for those who haven't heard of it. Betashares Direct lets people invest in over 350 ASX traded ETFs, not just from Betashares, but from other fund managers as well, with zero brokerage. And it can be downloaded and used now. You can download it on the App Store, Google Play, and our web version has also come out, and you can access that through the Betashares website. And what we're very excited about, also we've had a lot of interest in this, so we're very pleased to announce that we now, in addition to individual accounts for Betashares Direct, we also have the ability for people to sign up as SMSF and trust accounts. So there's some good news there for people who have been waiting for that. I know a lot of people have. So that about wraps things up. Thank you to everyone for joining in with us today, and thanks for all the fantastic questions that you all sent through. And particular big thanks to Hugh for giving us your time and all of your insightful answers.
No problem. Pleasure.
Have a great day, everyone, and we will catch you next time.
Thanks, everyone.